Samantha, how are you doing?
I'm doing well. Thank you so much.
We were just talking offline, and you were talking about your analysis and what we're going to talk about today. And we've never met before. And to give you an idea on my show, and when I started this 7 years ago, it's completely different now from what it is today. But I like to bring people on to make objective, so that the people that listen can make objective, informed decisions on what's best for them as individuals. And I don't know about you, I never thought somebody who's sitting in the White House is going to save us, no matter who it is. So that's why I'm really glad that you were able to, carve out some time to talk to me, because I'm very interested. To me, one of the most important things out there right now is, where are we at economically? Where is this all heading? What can an individual do to prepare as best they can for what I believe potentially is coming? I could be wrong. I mean, I'm wrong about everything, a lot of these stuff lately. But, right before we got online, I'm watching this Trump press conference with the Golden Dome, and I'm like, okay, what do we need this for? What is this? This is not important to me. What's important is, are these tax cuts going to get through, and also what's happening in Japan right now? I mean, and correct me here if I'm wrong, but I think what's happening in Japan with the bond market that's a big story.
It will be, but first to kind of back up, this is a pleasure to meet you. Obviously, you reached out, wanted to talk shop a little bit, and I'll do my best to answer, what I've got macro to micro style, which is my focus anyway, because I run a financial research firm with a whole trading desk of 10 subject matter experts. I am just one voice. So I pull on them quite a bit also when it comes to matters of fixed income. For example, I work with a classical economist, Jeffrey Fouvray, and he is brilliant when it comes to matters of fiscal dominance, like your guest, Luke Groman, and such. So I'll give my best perspective that I can on issues at hand. But yeah, right now we definitely have a lot of macro headwinds that could be coming our way, but it's focused on this tax cut and debt ceiling raise and how that's going to get pushed through. Because right now, obviously, President Trump on this May 20th just came out to kind of negotiate, bully in some cases, the GOP to get in alignment to pass this bill, this congressional reconciliation bill. And it is ginormous as it relates to extending the fiscal deficit. The spending is, the interest on debt expected to double from 1 trillion to 2 trillion. So there has been some pushback. It's actually a relief to finally see Moody's downgrade the US, and then some GOP folks stand up and say, hey, maybe we need to revisit this. It seems like it's too much. And we need to kind of revisit. Now, again, whether they actually do push these tax cuts through, Trump says if they do not, we're going to have a 60%, 68% tax hike. I don't know how he comes up with that math, but it definitely means that his 2017 tax cuts don't get extended. But as it relates to the debt ceiling, that's another matter. And we do need to have resolution, because Treasury Secretary Bessent has already come out and said we run out of money, by about August. So they need to deal with those two issues, tax cuts as well as the debt ceiling raise, sooner rather than later, or else the market will start to price in that uncertainty and potential government shutdown. And these are items that we really don't have any resolution to any more than we do on the trade tariff front. And that's another thing that's coming up front and center July and August. The delayed tariffs will actually go into effect July 8th for rest of world and August 10th for China. And that's why there's so much scurrying right now in front ordering as much as possible, US businesses anyway, to get their supplies in for the holidays, back to school, before the tariffs take effect. So there is a lot of chaos going on in the business world, not to mention the DC drama. Market is ignoring all of it as usual. It's mechanically driven higher with quantitative type funds that are price insensitive, with short covering, with buybacks. And then some retail jumps in and does the FOMO dance. So we basically have been here before. So I'm on the lookout for any selling underneath the surface that can create an air pocket of risk that then a macro event trigger will in fact prick and cause price to come back down. But we don't have that right now. So waiting for macro data to kind of roll out and reprice equities. But for right now, the backdrop is tactically bullish and macro bearish.
This episode is brought to you by McIlvaney Financial Group. Their advisors bring a depth of knowledge and experience that allow them to serve their clientele with care, ensuring their financial needs are met now and in the future. Personally, I'm not saying cash is worthless, but you can see what's happening. It's worth less every year. Gold is the opposite. Click on the promo link in the show notes or go to www.mcilvaney.com/coffee and a mic. You know, I had Porter Stansberry on not too long ago, and I've seen him put video clips saying the same message. The federal government, he says, like, repeat after me, the federal government will never cut spending. They will never, ever stop. And I'm paraphrasing that part, but the spending is up this year than what it was last year. And
correct.
And they're going to raise the debt ceiling, right? I mean, these people never cut.
Well, they have, this is something that Trump has allowed a government shutdown in the past during Trump 1.0 for about 35, 36 days. So that's where we're kind of going if they don't get this passed in July, August. It's already been kicked out. It's already, pushed down, I should say, the road. So we definitely have some rising risk. But if you look at Vegas odds of the tax cuts not getting extended, and the debt ceiling raised, it's like 95% chance they will be done in 2025. So the market is still pricing that in. It's not pricing in the risk of further delay or delinquency in the case of Bessent warning, we run out of money if we don't get the debt ceiling raised. So none of that's getting priced in right now, but that's the risk.
What are your thoughts on Bessent and LaDuc and the team he's put together?
LaDuc's the show pony that definitely is absolutely on the hot seat and doesn't mind it. In fact, loves it. I actually think LaDuc and the Cantor CEP fund around Bitcoin and all of the Bitcoin drive is very grift-like. So I'm not a fan. Bessent is chosen because of his very solid knowledge of Wall Street and market mechanisms. There's no question he's competent, but he is unfortunately doing some things which I think are damaging or just not in light of reality, like his bashing of China. I think that's a hubris for both Trump and Bessent. They're not giving China anywhere near enough credit. They're underestimating. And I think that's going to come back and pay dividends against the U.S. But for right now, they're going elsewhere, right? They're going to Saudi Arabia and Qatar and driving this perception of great financial influx of money, many, many times the multiple of the GDP of these respective countries. So it's a lot of perception, not reality, but it's also in trade for things that we probably value greatly as it relates to our AI ecosystem and chips and like. So there's definitely a bartering going on and the buying of treasuries because foreign demand has fallen and we do need bonds to get backstopped. So these deals that are going on almost with the devil are really not productive use of our money. It's to try and convince Wall Street that we're going to have this dependency, more dependency on other countries. We already owe 67 trillion in foreign debt relative to what we get in, 24 trillion. That's why we have such a big trade deficit. We are huge consumers. We don't pay for our consumption in gold. We don't pay for our goods consumption in exchange with our goods, soybeans, hogs, whatever. We really do it in the form of debt. So we're a debt-driven consumption society, and all this does is increase that real estate of more debt, but now would be beholden to the Middle East. I'm not a fan. So I would say that particular approach is detrimental for its short-term gain for longer-term pain to the US, so I'm not a fan. And I think underestimating China is definitely a mistake. But otherwise, he comes out and he talks about how tax cuts are going to offset trade tariffs. But again, he's not really focused on the fact that the inflation that has come about through massive stimulus since the bottom of COVID by both Trump and Biden have contributed to this entrenched inflation that we on Main Street feel intensely. It's compounding inflation year after year after year versus the rate of change inflation metrics like CPI that Wall Street uses to measure inflation. And that's the gaslighting that many with common sense go, wait a minute, inflation's not coming down. My home insurance, my health insurance, food prices. So they have this way of orchestrating a mantra of we are going to get inflation down through tariffs. It's not sensible. And the tax cuts right now are definitely benefiting Wall Street over Main Street. And that is proven. But there's not a way to back that out because ultimately, if the tax cuts don't get extended, there will be instant pain. In other words, that would be like a tax hike. Right now, if they're extended, we don't really feel the benefit because we already have them, right? They're already priced in. But if those tax cuts actually don't get extended, I'm not talking about whether they should or not. I'm just talking about the reality. If they don't get extended, that is the equivalent of a tax hike. And this will definitely hit. So consumers are already getting hit with higher prices. Wages are already coming down, relatively speaking. So we have a situation where the consumer is already starting to feel, and we have the hard data on that, but we don't have the unemployment rate spiking higher or jobless claims spiking higher yet. So we don't have that risk of recession getting pulled forward. But I think in the latter part of this year, we will start to revisit that stagflationary backdrop of contracting growth with higher prices, that recession risk pulled forward with rising jobless claims. And the bigger issue is for our market, a growth scare. So what really freaks out market participants, investors, but also foreign holders of US equities is when we have a growth scare, like we did from this most recent 4 months into the April low. We had a 10.5% pullback, but it was very quick. The rate of change was very fast, obviously much more for NASDAQ, until Trump came in and literally April 9th, midday, said we're going to delay the tariffs 90 days for rest of world. And that obviously helped those shorts cover and stabilize the market. And that also helped our bond market, which had been experiencing a convulsion. It was frozen. Credit and bonds were both in trouble because of the 10-year yield that rose very, very quickly from 3.9% to 4.5% in 4.5 days. So it isn't the level of yields only, it's the rate of change of those yields. And that is what caused the intervention on April 9th. So right now we have to look. Is Trump going to follow through with tariffs? Absolutely. July and August brings forward the risk, and the hit on consumers and companies will be felt starting this summer into the fall.
This is an observation that I have, and I want to share with you and tell me, what your thoughts are. And people I've spoken with now, mind you, I've never been to China, so I'm only going off of people that have been there, people that, are historic, understand from an economic standpoint who China is. But it's like they're painting this picture like China's the enemy, and yet would you say that they're a communist country any longer?
Oh, definitely communist, but it's not. Is it in the argument that they're the enemy, or that they actually have advanced greatly, and the administration is painting them as a threat because we are losing our dominance in certain areas that define U.S. exceptionalism. So, for example, we know China's number one in manufacturing. And I'm talking from cars to textiles. We made that happen. We outsourced those jobs. so that we could be consumers. And this is why I said we're the debtor, right? They also became number one in steel and cement production. So we know their commodity focus. That helped also with their focus concentration in shipbuilding, high-speed rail. U.S. doesn't do any of these. No other country does these critical infrastructure sectors of a thriving economy like China does. So I'm not even getting to tech yet. They are clearly, and they have been because of our U.S. dollar eminence, right? This hegemony is a double-edged sword. We can grow through debt, but at the same time, we're actually building up their fortress. So they are number one in industrial and commodity chemical production, rare earths, batteries, solar, EV, electric vehicles. They are number one in EV global sales. That's power, right? So the way that Trump and Bessent can label them as a threat is because of the example like DeepSeek. DeepSeek came in on January 20th. This is this free AI, which, clearly shows that they also have AI tech dominance that they were not really ready to roll out until they wanted to give a gift to Trump on Inauguration Day of January 20th. And that disrupted the semi space, the AI space. It also helped contribute to the precursor, the bloodbath, basically, that was happening in the semiconductor space before Trump even came out April 2nd with his announcements of the tariffs, right? So that whole point I'm trying to say is about now the threat of China being dominant in AI, in energy, in tech. And these are the areas where U.S. has relied heavily on its abilities in AI and tech and energy, right, in the sciences. That has been a world leader that is looked up to. When in reality, China is doing that. They have leapfrogged ahead. So any amount of talking down China's advances by Trump and Bessent is underestimating or gaslighting. It's one of the two. So I don't know if they're doing it on purpose, and they know, but that episode, for example, with DeepSeek, or with their fusion technology, or with their battery technology, should be a tipping point for U.S. confidence. It should be a reminder that we do have a threat to the end of American tech dominance. There's no question. And the problem that becomes a bigger issue is what happens if the U.S. stock market, which is the biggest, focus of money, bar none, right, as far as our equities are stronger than any other stock market in the world. We focus so much on the financialization and the support of companies that are in our stock market. We have a thing called concentration risk, where U.S. has built up this not only financialization of markets, but also the Magnificent Seven, the big mega cap tech weighting, which for 15 years, right, post 2009 great financial crisis, has really contributed to the market's advance as well as to our economy's advance. They're now tied very, very closely together. By that, I mean the GDP, okay, I'm talking about specifically big tech stocks in the US, the value is 15.4 trillion as of this time last year. So I don't have this year's data, but I got Q2 2024, right? Market cap 15.4 trillion, and US GDP is 28.6 trillion. That's 60% of US GDP is Magnificent Seven market cap right there. It's unbelievably high. So that puts our economy actually at risk should China attack our technology dominance. They can attack Mag 7. If they attack Mag 7, our stock market falls. If our stock market falls, so too does our economy, because we are so intertwined. The stock market is the economy in the US, not the same in China, not at all. Their stock market is not the economy. There isn't as much importance to it at all. So it is actually important what's happening in China But it's also important to kind of look at the noise of what Trump and Besant are saying versus the reality of where China is really strong, not weak, and how that is a risk by ignoring it or trying to threaten or bully China. It doesn't make a lot of sense. It would be much more productive to collaborate, but that's not their MO for whatever reason.
Do you think the United States is looking at that and, to add to what you just said and saying maybe this is what the direction we need to head in the future, and that's where this kind of reindustrialization and them attempting to not make, but have these countries and corporations pump this money back in the United States because they look at China's model and say, this is working?
But that's not possible. They're communist countries, so they can absolutely, without committee, go in and fund the areas that they want to fund in science and energy, in tech. We have a capitalist society. It's very, very different. So there's also the issue where there is a bigger risk of this turning into like a Manhattan Project 2.0, which is in the US, we have a bigger problem than just tariffs. So this whole artificial superintelligence area, it is also keyed into defense technologies. And we're way behind relative to China as well. And I think that's part of the reason that we have kind of a special place. Trump has a special place for China as it relates to the tariffs. Remember, they were 145%, not 10%, right? And then they ratcheted up to 45 to 145, and he threatened more. So it hurts China, sure, but it hurts us more since we're major importers. And I know the idea is to help force U.S. consumers to consume locally, and it's to incentivize U.S. companies to build locally for U.S. consumption. I get that. That's the trade balance, but it takes years. We have to unwind decades, right? So this fast and furious approach makes me wonder if this is a little bit more than just the goods trade deficit that we experience with China in general. It's more who's going to be king of the mountain. So there's this very, very big risk that in the past, the Manhattan Project, 1.0 was all about who could get to the atomic bomb first. AI is the neutron bomb of information. That's not my expression. That's actually a client of mine who worked on the Manhattan Project. He's older, but he's an older gentleman who and I were discussing what the impact was from this DeepSeek introduction on January 20th, Inauguration Day. And that's how he basically phrased it. And that stuck with me, that this is like a neutron bomb of information. So if it behaves, great, but we have a lot of risk. We've seen electricity grids go offline. Spain was a good example that hit hospitals too, flights, everything was grounded. So we have to be, I'm sure, kind of giving a little bit of room here to the fear that Trump and Besant must feel about China's advance. There's no question, but they're not letting on to it. Instead, they're just, the bully, the tariff, the terrors, and basically trying to go elsewhere to replace China's infusion of capital in the US. Remember, we have a very big imbalance with China's and other countries, but especially China's ownership of assets here in the US. Equities, bonds, real estate, a little bit of businesses. So in order to decouple from that, it would be painful. So I think this is basically an effort by the Trump administration to force money to go home. And not just China, but elsewhere. And they have. They are going and investing in other countries. They're taking it back. And there's more incentive for them to repatriate dollars back into yen or yuan or what have you. But the implication is that we'll become destabilizing to our equity market. So about 20%, probably more, of equities are owned by foreign holders. So if they start going home, which they already have, that could become even more troublesome for our tech wreck that is possible with our equity market. So I'm focused on the concentration risk and how that unwind can be gentle or rough. And for right now, we had a little teaser there back in February through April before Trump did a policy intervention and purposefully delayed tariffs. Well, that all comes back to the forefront on in mid-July and again mid-August.
Describe, painful decoupling from China. What does that mean for an individual?
Well, for an individual, now remember, I'm more macro, so I'm kind of looking at the bigger picture.
Sure.
The dollar would fall, yields would rise. That is definitely troublesome as it relates to refinancing for both corporations and individuals, households. The government also, it's higher interest on the debt that is owed, not just the fiscal spending that they're trying to increase, but also the debt that we have to pay on that. The interest that we have to pay on that debt is swamping what is reasonable for bondholders to kind of justify their investment. They demand higher yields. So it's actually it's problematic. And then we get yields that go above a certain level. I've got my line in the sand that I think is going to start to trigger headwinds. But once we get above a certain level, then we start to get inflation that gets a little bit more out of control. Right now, they still have levers, right? We could do a Fed cut. SLR is basically a relief of capital weighting by banks. So it's another way to kind of absorb some of the bonds that are losing demand. There are definitely mechanisms, but they're few and far between, especially as gold has been bid up by China, especially China, but other countries as well, as they settle their trade outside of the US dollar, and they settle their trade with other countries directly outside of the US dollar, or they settle their trade with other countries outside of the petrodollar. So there's less dependence on US oil and US denominated currencies and assets. So it's become a kind of a sea change in that before we had this great position of, look at me, look at me, look at me. And now the countries are saying, but we don't need you. So you're going to go Independence Day, as Trump likes to call it, is really going to be isolation day. And so they are decoupling already. China was in a lockdown, not for a month like we were, but 2 years. So they are already well in advance of this effort to bear the brunt of the pain that comes from changes in currency and changes in economic activity. So it's not that it's going to be a cakewalk for them, but it's definitely going to be less impactful than it is here when we have a very vocal populace, right? And we have a very distracted, let's just call it, I don't know, I'm trying to use a political term here that's nice.
Be not nice, Samantha. I don't care.
Political.
Be not nice. That's fine.
A very divisive political backdrop. So I think that this is coming to a head very soon. But for right now, Trump is trying to replace China with the Middle East, is trying to talk up the bond market, keep equities bid. And for right now, the market loves free money. But at some point, we actually have to have the fundamental buyers and the fundamental macro drivers to keep it bid. And that's where I think we're going to have some trouble toward the end of the year.
Can you believe, and for as long as you've been doing all this, where we're at right now? I mean, you were paying attention in 2008, you were in that, watching, and look where we are now. It's just an incredible time. It's an incredible time that I get to talk to people like you about this stuff.
Well, I can only say that I look for macro event risk, and the rest of the time the market's bullish, right? So the way that this works is the market goes up 80% of the time. So I'm not fighting that. That'd be silly. I focus very much on macro trends and sector rotation and stock selection, and 80% of the time the market goes up. Then we have these risk off events, and that's what I want to look for. That's where I want to protect clients. And these are the things that I'm looking at big picture, which is, Chinese world domination was never on my 2025 bingo card, right? So this is a process. Tops are a process. Bottoms are an event. Bottoms are policy intervention. So the question is, what policy intervention can the Trump administration roll out next? Doge, unfortunately, it had success, but limited to what was promised, and then it was rejected. Johnson took it out of the bill, and what? So Lutnick is, of course, again, a show pony for mostly Bitcoin and many things that are unscrupulous, in my humble opinion. So I kind of discount him. But Trump had good ideas of deregulation, right? And the talk of helping Main Street. But the reality is exploding spending, higher interest on debt is actually fiscal dominance 101. And it actually creates a destabilizing force for what's valued about America, which is our dollar, the collateral of treasuries, which are falling in demand, yields rising, which is inflationary with everything else that is inflationary, like tariffs, and ultimately not another economic engine. So the AI was really the engine of the past few years that helped the NASDAQ, for example, double from 2023 January to December 2024. The NASDAQ doubled. That was in combination with policy intervention, but also that backdrop. And I think there are a bunch of bulls that would argue very strongly that the AI chip battle will continue, and the AI ecosystem is strong. It's definitely not going away. I'm not arguing that. But I think that there's more competition now. And US restrictions, for example, to try and clamp down on China's domestic chip strategy, they're manufacturing their own chips. They don't need ASML, which many thought was unimaginable. They don't need NVIDIA. And NVIDIA is still doing an end run through Malaysia to the billions and billions and billions of dollars worth, while US sales stay flat. So there's a lot that's being ignored, but that's what the market does best, so that it can continue to keep the narrative of never bet against America. But I think right now it is a good time. Few on Wall Street are really saying it out loud that US exceptionalism was an argument to make for the past 15 years. It's not an argument to make for the next. And that's what gets a lot of pushback. So we'll see.
Why do you think you get so much pushback? Because people aren't willing to come to terms where we really are?
Because America is great, but it has great GDP and great inventions and great companies and great people and et cetera. It's not debatable that we have been a growth engine for the rest of the world. No question about it. The question is what happens moving forward? How do we maintain that growth engine? Especially with the points that I've just made about China leapfrogging ahead in not just areas of industrial and manufacturing, but also technology, science, and energy. It's a new world, but very few are allowed to see that part unless you're an analyst or, like me, have a desk full of them. So it's very big change coming, but they've been saying that for a long time, right? But I'm talking, this is a big change with the attack on China. It's an underestimation of what they have really accomplished and where they are taking over. So I think it bears watching.
Yeah, the evolution of AI and the rate it seems to be just accelerating now, it's quite remarkable. And I even use a reference in Arizona where I live, these Waymo cars that are they're everywhere. Everywhere. And how long before those, grow, turns into buses and turns into, I don't know how they would do that, like where I'm from in Ohio with the snow. I'm sure maybe they're working on that somewhere. But
a lot of it has to do with batteries.
Battery. Well, I just wonder if you're in a snowstorm, can you send those things out? If you hit an ice patch, how is it going to know to pump the brake?
Well, these are all very practical concerns, and I know in the United States that there is not a movement to go from ICE or internal, combustion engine cars to electric vehicle. Tesla is more of a status symbol than it is a source of cost savings. But in China, you can get a GM SUV for under $15,000 for your entire brand new for your entire family. You cannot get here. It's 65,000. That's no joke. It's EV over there because China, as a communist country, has mandated a rotation out of gas dependent vehicles to electric vehicles. Full stop. And they've invested in the battery technology to make it happen and in the pollution reduction. So they've put their efforts, right, into making this a mandate. So the incentive to buy, if you're a Chinese consumer, you're like, oh my God, I can get a brand new car for $8,000. I can get a family, minivan for $15,000. And I don't have to spend money on gasoline. That's a stimulus for their consumers. We don't have that here. So the oil industry, again, the EV rotation, I should say rollout is greatly hampered by the insurance coverage that they control. They are the gatekeepers. So we have a very, very different system here than they do in China. That's why China can advance so quickly, because their government says we will have a 50% EV adoption by 2030. And they're already 4 years ahead of time. So that's why they have become the number one seller of electric vehicles globally, because they put money into companies that were focused on that. And they incentivized their consumers to buy that. We don't have that over here. So I don't know if that answers your question, but I don't know how that's going to work out in where I'm from in upstate New York. Yeah, definitely. But the reality is it's happening elsewhere and it will make its way here. There'll be resistance, of course, but there'll also be, in times, the technology, not just auto, the driving that Waymo and Tesla and others do mostly in cities versus what's going on in just consumer behavior of migrating to EV. It's just going to be a lot slower rollout, and it's not going to happen until the insurance companies actually come on board and make it possible. Because right now it's cost inefficient.
Yeah, you wonder if it moves to what you said, more driverless and even more of these Waymo cars, and they can figure out how to do that, on a national level. What kind of impact would that have on the insurance companies? Because if we're all just taking Waymos to go to the store and do everything, I mean, you could essentially do away with the insurance.
Well, I don't know about any of that. I mean, that reliance is a little bit further out in the future. I'm just talking about not the driverless car, but the transition from gas to electric. That's all. That transition is critical. So we don't have that. They're advanced. That's all I'm trying to say.
How far do you think we are from that, gas to electric?
Like I said, it's way not close.
Like decades, you think?
No, I don't know. I can't make that crystal ball kind of jump. I can tell you what I have right now, which is a lot of resistance, not just oil and gas industry, but also the insurance industry, and consumer behavior is very different here, and there's no mandate to require it. So it could be a while. Doesn't mean oil is going to be bid, though. It means globally, oil demand is falling. And that will hurt the oil and gas industry in the United States, right? We're not OPEC, with just 7 countries to worry about. We have 100 plus of independents that are going to go belly up as oil prices continue to fall. So there'll be a reckoning that they have to make some changes. But for right now, they're going to fight it tooth and nail. But yeah, I can see an oil industry recession coming to the US before we have any transition to EV. And this is, by the way, this is not a Democrat or a Republican principle. This is just cost. efficiencies and technology drivers. The government in China has forced this rotation, transition, because they don't have their own supply. They have to import gas, right? They have to import oil. They will import oil, refine it to gas. The point is, they're in a very different situation. So it was really to their benefit to drive this initiative. We have our own stuff, so it's going to be a slower rollout.
That's probably China's. Sorry, I didn't mean to cut you off. That's probably China's biggest deficiency, right? The fact that they have to import all their oil.
Deficiency, yeah, but they don't need it so much anymore.
Right,
They
right.
have already dropped their dependency for ground transportation and oil by 50%. It's tremendous. Again, leapfrogging, but we can't compare it to the US because we're not doing that. So I'm just saying underestimating China by Trump at percent is a big mistake.
What is your top concern as we sit here today?
Oh, geez, it isn't a top concern. I look for macro event risk. So I'll be looking at dollar yen. You talked about bonds, Japanese bonds, a 30 and 40 year yield just spiked recently. They had a poor auction. Their prime minister came out and said, we're, no better off than Greece, which, it was a shocking, startling kind of comment. It probably stemmed after the Moody's downgrade of the US credit on Friday evening that kind of triggered globally this revisiting of, wait a minute, how safe are our is sovereign debt, because it really is a repricing. So I think that this is one area. Besant wants the yen to appreciate, but the yen is tied to yen carry trades, and that unwind, like we had in July of last year, resulted in NASDAQ falling 25% in a month. The semis falling 35%. No, 25%. That's right. 15% NASDAQ, 25% semis, and 35% for NVIDIA in a few weeks. So that was a yen carry trade or a currency volatility event. So we could have that again quite easily. I look for that. I look for Besant talking about taxing foreign holding. Now, right now we have a tax treaty where they're not taxed on their holdings of U.S. Property, equities, etc. If they change that as a revenue generator, guess what happens? Money goes home. So money leaves the U.S. market, and they demand fewer dollars. That causes the dollar to fall. It also causes equities to fall. It causes bonds to fall and yields to rise. You get where this goes? So we have a big dependency on foreign holders of our assets. And if they leave, what will replace that? So that I look at that type of kind of macro event risk on policy changes. I look at jobless claims. When do the severance packages from the recent layoffs by Doge at the beginning of the year, the 130 days that Musk had to come in and kind of create some efficiencies in government, a lot of that was pushed back. But those layoffs, as they start to come into the jobless numbers, they start to percolate higher, and that labor shedding begets labor shedding, and then that will increase jobless claims, and that will pull forward recession risk. So hard data to me right now is just starting to show weakness in the consumer, weakness in the employment space, bankruptcies, student loan debt, all that kind of stuff. But big picture, we don't have the recession risk here front and center until we can get a definitive result from the trade terrors, right? That they've delayed it, they've reduced it. It's all over the place. Until we can get some certainty about what the tariffs look like and the tax cuts, we don't really know. So we're waiting for that definition.
I know I'm running out of time here with you, but two things. I want to get your take on your thoughts on Bitcoin. I've been talking about that a lot lately, and it's funny. I make it a point now to, when I talk to younger people, and I was not this before, so I'm trying to be more conscious of like listening to them and where they're at and what they're doing. And and so I've talked to of several young people, and they're all like Bitcoin, 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 and obviously when I was in my early 20s, that was not a thing. But first of all, why do you think younger people are gravitating towards it? If you have an opinion on it, and two, what are your thoughts of Bitcoin?
In general, I think it is for those in need and those in greed. So it is a speculative asset and nothing more. So I look at it as a liquidity tell. Lots and lots of liquidity flooded into the markets from really 2009, great financial crisis. And we've just had easing and stimulus ever since. So the fact that Bitcoin has kind of been this absorber of inflation and very speculative asset that excites because people are weary of US dollar devaluation and trying to find a group that believes the same, I think is a little bit dangerous. In other words, to bet on America's failure, but at the same time, to bet on something that really has mysterious origins and is a cult-like following. So I know that many argue that this is a proxy for treasuries, and I understand their reasoning, but it's not my game. I see it has zero value as a commodity. It cannot be used as an input for any physical good. It's not like gold is used for jewelry, for example. Silver is used in industrial production. You can't use it. It's great for those who are in need. It's a small fraction of the transactional base of the global population that they need to get their money out of Ukraine or some third world country or hyperinflation. They need to transact in something else. That's fine. But mostly it's used by grifters, and it really, really is for those in greed and this kind of holding that they have, which is suspect. So it has zero value as a commodity. It's not used in any productive good. It actually diverts productive use of money because there's so much speculation in Bitcoin that it is actually used as a proxy instead of real things. In other words, it does not create any value. The money is put into Bitcoin instead into productive use or production of industry, production of projects, people. So it has zero value as an economic builder. It also has zero value as a security, assets and such, as far as that kind of currency, commodity, security, because it doesn't distribute any coupon. It has no dividend. So it's not like a stock, and you can get you're buying the future return of that asset, and also you can be dividend or a coupon or a yield, something that you can get as a result of owning that issue. It doesn't have you can also have a liquidation preference. You don't have that with Bitcoin. Its only value is as a means of kind of circulation that is limited. It is not a huge transaction base. It is definitely very, very limited in its circulation. So I'm not really excited about it. I think that there's a lot of grift associated with it. Until we can get Bitcoin to be used to pay the IRS to collect taxes, it's not a serious form of money. It is just a speculative asset. So I'm not excited about it, but I know people are, and that's fine. I mentioned that Jeffrey on my trading desk, he's a classical economist, and he says it's a liquidity decoy. So he really believes, and he's an expert in emerging market debt, and he says that it's not digital gold, but in fact a way to prop up the dollar by absorbing liquidity away from commodities. So if the liquidity was to go into food or metals, for example, we'd get higher prices, we'd get higher inflation, we'd get higher interest costs, but it's going into Bitcoin, so it's actually keeping a cap on inflation. So anyway, that's one way of looking at it, but I'm still not, I don't think it's really suitable for much except for speculation, and full stop. I have more interest in gold and in assets, real as well as paper, but not Bitcoin.
My last question. Is it hard for you to break away from this stuff? Like, could you take a week off and not look at any of this?
I'm going to try. Last week of June, I'm going to go spend a week with my daughter in France, and I don't take proper vacations and take a look away from the market because it's right now also constantly changing. Really, really. I don't mean just earnings season or economic data that comes out. I'm talking about the headline risk that we have with this mercurial president. So it's very hard to look away. It was exhausting when he first came in with all the headline risk and navigating that for clients. But we did a good job, thank goodness, of navigating for clients. And now we're kind of waiting for the next shoe to drop. But it is hard to tap off. It's especially hard because I have to be in tune with it. I mean, I run live trading rooms. I have, daily client deliverables, trade setups that have to be managed across chase, swing, and trend across all asset classes. And Bitcoin, by the way, is a proxy for speculation, so I have to follow that as well. But mostly, it is going to be hard to tap off when I'm on vacation because it's right before the tariffs are supposed to go into effect, and the market might be in some disbelief or in some distress. And so it's going to be very hard to tap off the last week of June, but I'm going to try.
So when you do that, I mean, do you wake up on Eastern Standard Time in Europe and it just...
No, just I have we all have our ways of like making sure that we're, in tune with the market. I'm also really blessed that I have a team, right? So I am not a subject matter expert on what's going on in DC and the play-by-play of the gatekeepers of the rules committee and all of this stuff. So I'm very fortunate that I have someone who's very focused on that. And I have another who's very focused on fixed income. And you know what I mean? So I have a team that actually also helps me stay up to date on the latest and greatest. So I have that benefit.
Where can people find you, Samantha?
LaDucTrading.com, LADUC trading.com, and also on X at Samantha LaDuc. And I have a mini me product at Substack, which is also at Samantha LaDuc. It doesn't have the full offering of our full financial research firm. It has my market thoughts and a recorded live trading room, but it is it's an entry kind of level to kind of see some of my analysis on all of the things that we've talked about. And I thank you very much, Michael, for this invite. I hope it added some nuance anyway, at least how I'm looking at things coming up and past. And I appreciate the offer to talk about it.
Samantha, thank you so much. Thank you for everything you're doing, and have a good trip. Try to unplug the best you can. And
I will try.
I look forward to, well, hold on, last question. When you go to Europe, when you go to France, do we have some croissants, wine?
Of course. I mean, why? Yes. Yes. But I'm letting my daughter lead. She actually lives in Zurich. So this is kind of her idea of she'll pick everything out and I just have to tuck in and pay for it.
Chocolate too? We have some chocolate while you're there?
Without a question. No restrictions, no allergies. Yeah, I will not say no.
Thank you so much. Safe travels, and look
Thank
forward
you.
to continuing to follow your work and having more conversations ahead.
Appreciate it very much. Have a great week.
Mic drop.
Bye.